G'day Gain Squad. I'm coming to you from a very rainy Sydney with some massive market updates. Let's see where the smart money is flowing today, because the last 72 hours have been absolute chaos. We're recapping the wild gold price swings between March 23rd and March 25th, 2026. We're looking at the big rotation from failing US tech stocks back into our world-class Aussie gold miners. Plus, we'll analyse why the Strait of Hormuz conflict is causing a weird paradox for your investment portfolio. Quick disclaimer, this isn't financial advice, just my view on the charts, so do your own homework. The big question today, is the gold bottom over at $4,000 or is there more pain? Tell me your price targets in the comments and smash that like and subscribe button for the squad. Breaking news first, the Hormuz Shock has completely flipped the script for global markets this week. On Monday, March 23rd, gold hit a terrifying 4-month low of $4,098. This happened after Iranian strikes on Qatari gas facilities knocked out 17% of their export capacity. However, on Tuesday, March 24th, President Trump signaled progress in talks to end the Middle East war. Trump offered a 5-day reprieve on bombing Iranian power plants, which sent a relief rally through markets. Tehran denied the talks, but the Trump reprieve was enough to stop the bleeding for the gold getters. By Wednesday, March 25th, a 15-point peace proposal was leaked, sparking massive optimism for de-escalation. The proposal covers nuclear dismantlement and a guarantee to keep the Strait of Hormuz open for global trade. Gold responded by jumping 2% on Wednesday, reclaiming the $4,500 level easily. It's been a proper roller coaster, but the de-escalation news is acting like a cool drink on a hot day. We're seeing risk appetite return to the markets as the threat of an all-out energy war finally subsides. But stay alert, because a single tweet can still move this market 10% in either direction. Let's check the energy markets, where WTI crude oil has been having a bit of a wobbler this week. Oil prices shot up to a brief spike near $120 on the initial war news. By Tuesday, March 24th, WTI crude retreated slightly to $91.53 per barrel. This retreat in oil is massive for gold, because it eases the fears of runaway global inflation. We also have to look at the OVX, which is the CBOE crude oil volatility index. The OVX has been trading at historic levels, sitting near 90 on March 24th, which is pure madness. High oil volatility usually forces institutional traders to dump their gold just to cover their energy losses. It's been a double-edged sword for the gold getters who expected a safe haven jump but got a liquidation instead. But on Wednesday, the OVX started to cool down, giving the gold price more room to breathe. If oil stays below $100, it gives the central banks a reason to stop being so hawkish. The US dollar index, or the DXY, is another huge factor we've been tracking very closely. On Monday, the DXY was holding strong near 100 points, acting like a magnet for global cash. But as the peace talks gained traction on Wednesday, the dollar slipped back to 99.46. A weaker greenback makes gold cheaper for everyone else, which is why we saw that nice price bounce. The currency market is seeing a lot of smart money moving out of the safe haven dollar. This shift is helping the Aussie dollar, which is trying to claw back some ground. For us in Sydney, a stronger Aussie dollar can sometimes limit our local gold gains in Aussie terms. But the main story is the global pivot away from the dollar as de-dollarization trends continue to grow. Central banks in Indonesia and Malaysia are reportedly buying gold for the first time ever this year. This broadens the demand base for gold and makes this dip look like a very strategic entry. Now, let's look at the ASX versus the S&P 500, because home is where the gains are. On Wednesday, the ASX 200 jumped 1.85% to close at 8,534. This was the strongest daily advance since February, and it was a massive win for Aussie traders. Meanwhile, the S&P 500 in the US has been struggling to stay in positive territory. The Aussie market is benefiting from a violent rotation away from US tech and into our miners. Our ASX is weighted toward real things like iron ore and gold, which investors suddenly want again. We're seeing a proper homecoming for Aussie shares as international funds look for value and dividends. The S&P 500 is currently down about 1.9% for the year so far, but our local ASX 200 is showing serious resilience compared to the high-flying tech sectors in America. Let's deep dive into those gold miners because they were absolutely on fire on Wednesday afternoon. The ASX All Ordinaries Gold Index surged over 8% in a single day, which is a total beaut. Evolution Mining led the pack with a massive gain of 8.5% on Wednesday's close. Northern Star Resources also climbed 2% to reach $17.55 per share. Genesis Minerals was a star performer too, jumping over 7% to $5.73. Even Newmont was up nearly 5%, reaching $137.74. These miners are providing what we call operational leverage to the rising gold price, which is delicious. When gold goes up 1%, these mining stocks can often jump 2 or 3% easily. It's because their mining costs are fixed, so any gold price increase goes straight to their bottom line. Many Aussie miners are currently trading at less than 5 times their forward earnings, which is super cheap. Compared to US tech, which is still very expensive, our Aussie miners look like the play of the year. Smart money is realizing that the Aussie gold sector has been unfairly punished during the recent market crash. Local investors are seeing this as a proper golden entry before the next phase of the bull run. Even with the recent volatility, these mining companies are making massive piles of cash at current prices. So don't let the short-term wobblers scare you out of what is a very strong long-term trend. The rotation back home to Aussie shares is the biggest theme for March 2026 so far. Let's flip the script and talk about the carnage in the Magnificent Seven tech stocks in America. The group, including Nvidia, Apple, and Microsoft, is currently weighing down the entire S&P 500. These 7 companies now represent a massive 33.3% of the total index value. Microsoft has been the biggest loser, dropping 17.4% so far in 2026. Tesla isn't doing much better, down 11.3% as the AI hype starts to fade away. The earnings growth for these tech giants has basically been cut in half compared to last year. Nvidia is still the biggest contributor, but even it is struggling to keep the index above water. Apple has dropped from first place to third in the market cap rankings, which is a massive shift. Investors are starting to realize that you can't have infinite growth in a world with rising energy costs. As tech stalls, investors are looking for value-oriented spaces where they can find better entry prices. This is why the other 493 stocks in the index are starting to outperform. But the sheer weight of the Magnificent Seven makes it hard for the broader market to move higher. If these 7 stocks drop another 5%, the rest of the market needs a miracle to stay flat. We're seeing a violent rotation away from the big tech generals that have led the way for years. This tech sell-off is creating a massive liquidity squeeze that is actually hurting gold in the short term. Traders are having to sell their profitable gold positions just to cover their losing tech trades. This is what analysts call the paper market flush, and it's something every gold getter should understand. It's not about the gold being bad, it's about the tech traders needing cash to stay alive right now. Once this tech flushing is over, gold should have a much clearer path to move toward new highs. The era of tech dominance is looking a bit tired, and the era of hard assets is just beginning. We're also seeing major legal shocks hitting companies like Meta and Google over social media negligence. Huge jury verdicts in the US are adding another layer of risk to these already struggling tech names. When you add it all up, the risk-reward for tech isn't nearly as good as it used to be. I'd much rather be sitting on a gold mine in Western Australia than a tech bubble in California. The market's having a bit of a wobbler with these tech valuations, so keep your eyes on the miners. Speaking of tech bubbles, the sentiment over on Wall Street Bets is getting pretty spicy this week. The traders there are sounding the alarm, with warnings that a short ladder attack is incoming for tech. Many users are betting on an extinction-level event for people holding call options on the S&P 500. They're using phrases like unexpected headwinds to describe the mess that most CEOs are currently facing. Some of the most popular posts describe the global supply chains as being Viet Conged or in absolute shambles. The consensus on Reddit is that nothing is priced in, and more volatility is heading our way very fast. There's a lot of bear energy for industrials and semis that rely on shipping through the Middle East. But interestingly, some traders are starting to eye gold miners as the obvious buy for 2026. They're realizing that you can't just print more physical gold when the currency starts to lose its trust. One user mentioned that much of the tech price action was just speculation and didn't reflect actual demand. This retail shift away from tech and toward commodities is a massive signal for the smart money squad. When even the Reddit crowd starts hedging with gold, you know the cycle is finally starting to turn. Wall Street Bets is looking at SPY puts as a way to profit from the coming carnage in the tech sector. They're also keeping a very close eye on the social media legal shocks that could wipe out billions in value. The memes are getting darker, which usually means we're getting close to a major market turning point. Now, let's optimize this entry with some technical analysis on the daily gold chart for March 25th. The Relative Strength Index, or RSI, has hit a deeply oversold level of 27 this week. This is the lowest RSI reading since November 2024, signaling a major bounce is overdue. We have a pivotal resistance at the 50-day exponential moving average at 4,960. Gold is currently riding the lower Bollinger Band, with the bands expanding, showing that volatility is sky high. Our critical support is the 200-day moving average near $4,200 per ounce. A death cross hasn't happened yet, but we're watching the 50-day average move toward the 200-day line. This is a proper golden entry if the RSI starts to turn back up from these extreme lows. So, to summarize, gold bottomed at $4,098 on Monday before jumping back to $4,500. De-escalation talks in the Middle East are cooling down the oil prices and the OVX volatility index. Aussie gold miners like Evolution and Northern Star are leading a massive rotation back into our local share market. The US tech sector is in serious pain, with the Magnificent Seven stocks significantly underperforming the broader market. Wall Street bet sentiment is turning bearish on tech as they brace for a short ladder attack and legal shocks. Our technicals show gold is deeply oversold on the RSI, which is often the start of a massive rally. The smart money is rotating out of overvalued tech and into hard assets like gold and Aussie miners. This shift shows that the fundamental bull case for gold is still fair dinkum despite the recent wobbler. What's your move for the end of the week? Is the gold bottom finally in for the squad? Tell me your thoughts in the comments below, and remember to smash that like and subscribe button. Keep your positions tight and gains golden. I'll see you at the next close. Cheers. Stay active, stay legendary. Catch ya.